The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
This is Denise Nostrom, CEO and founder of Diversified Financial Solutions. Now more than ever, investment advice is needed. Not just where best to invest your money, but why. Are you investing for your future retirement? Are you retired and looking to maximize your income? Are you maximizing your income and concerned with leaving money for your loved ones? Are you investing for your retirement at the same time saving for your children's education and at the same time saving to buy another home? Are the markets in line with your goals? Are your goals ever changing? Please contact me at 631-758-8691. That's 631-758-8691, or visit us at diversifiedfinancial.biz. For over 25 years, I have been helping individuals, families, and business owners navigate through all market conditions with only one goal in mind, my clients. Visit me at diversifiedfinancial.biz or call Denise Nostrom, founder of Diversified Financial Solutions, at 631-758-8691. That's 631-758-8691 for a conversation about my most important client, you. Hello, thank you for tuning in and spending some time with me today. It is Friday. You are listening to The Financial Chick Show, and I am The Financial Chick. My name is Denise Nostrom, the CEO and owner of Diversified Financial Solutions, a full-service independent financial planning firm located in Medford. I am here live every Friday from 5:30 p.m. to 6 p.m. on 103.9 LI News Radio. Your Financial Chick is here to help you make better financial decisions and choices to improve your life and reduce your anxiety and stress about money. If you have any questions on anything we discuss on the show, you can check out my website at financialchickshow.com. We are also on Facebook and Instagram at Diversified Financial Solutions. So like our pages to get updates and see what is happening. So I hope everybody's doing well out there. Another crazy week. I'm doing well, but a little bit tired. As I had been talking the past couple of weeks, we were planning for my nonprofit women's organization, Power of Women Exchanging Resources, 9th anniversary and 4th business, a Woman in Business Award brunch that actually happened this past Sunday. So, it was a lot of work. The board and I had been, we all work full time, and we were doing all the preparations for the brunch at the same time. So it was a lot of stuff. So last weekend for me was consumed by power tasks, running around, getting paperwork and getting baskets and all that kind of stuff. But so it is a lot of work. But when it turns out amazing, it's all worth it. So I want to say a big thank you to everybody that came out. We had a little over 60 people, women and men, who came out to join us. We honored my good friend and fellow board member, Kim Dominici, who was, it was a very well-deserved honor for her. She's a special education teacher. She runs a health and wellness business on the side, plus being a wife and a mother of 3 great kids. She has her hands full, like most of us women out there, but she makes it look easy, and she does quite the job as well. I also want to thank our Assemblyman Joe DeStefano for providing a proclamation to Kim. But I want to give a big thank you to Senator Alexis Wyke and Councilman Neil Foley for coming out to present our honoree with proclamations for her special day. She was definitely super surprised about that, and was even more surprised when Councilman Neil Foley told her that November 14th, which was the day of the brunch, was now her day in the town of Brookhaven. So definitely sweet. It's awesome when the community and community members come together for such a great cause. In addition, we had 48 baskets for the Chinese auction, and we also had a 50-50 raffle. There was a delicious brunch with unlimited mimosas and Bloody Marys. And I want to give a big thank you to Andy at Sunset Harbor. You made the event just amazing, and your staff, especially Susan, were just amazing. And you guys helped us, and we got such great feedback from the brunch about the venue, about the food, and everything. So I don't have the final numbers, but I do believe we raised just under $2,000 from the 50-50 raffle and the baskets. So, which is great. That's going to be used for the scholarship program that we do for the schools, Patrick Medford, Bayshore, and we're going to be newly going into Sachem this year. So if you have seniors in any of those high schools, make sure that they sign up for the Power of Women Exchanging Resources scholarship program. And we also brought in some new individuals and business supporters into the organization, which was great. So we are growing our membership as well. I was just overwhelmed. It was a fabulous event, and we're very excited to start the new year with our programming and do some great things and uplift women and do some great things for the community as well. There might also be, I don't know if any of you have been, but we had a small business crawl last year, which was virtual, but the year before was in person, of course, before the pandemic. We're probably going to do that again. So maybe you'll see something come down the pike that way. And that's a lot of fun. And that's a way to help these small business owners, especially with everything going on with the pandemic. And, this week, a lot of news has come out. And, I think those small business owners are definitely going to need help. I think we all need help, really. It's been quite the time. Well, I guess to kind of keep it again, I don't like to keep it negative, but positive. Also this week on Wednesday night, my daughter and I went to her gymnastics awards dinner at Villa Lombardi's, which was wonderful. And she made all league at her school, and her school, Patchogue Medford, actually in League 3, they won in that division. So that was pretty exciting too. So we've been busy and, doing a lot of different things. And just as we're busy, the market's been pretty darn busy this week too. And, overall, wasn't the best week for the Dow. The Dow was down this week, along with cryptocurrency. But the NASDAQ this week hit an all-time high. So it's just been a really, really interesting run in the marketplace. But I wanted to kind of go over where we are now and then where we were last year. So this year, when we look at a lot of the indexes, the S&P 500, which is indicative of 500 companies, and the Standard & Poor's 500, the Dow Jones, which is 30 stocks, the NASDAQ, which is another index, which typically is your technology stocks, the Russell 2000, which is the 2,000 smallest companies, then we have foreign stocks or international, and then we have emerging markets. So year to date, all of these indexes are up high double digits. Just to kind of give you a few, the S&P is up 26.2%, the Dow Jones up 19.8%, the NASDAQ 23.7%, and this is ending last Friday, November 12th. The Russell 2000s 23%, foreign stocks 12%, and emerging markets rounding it off, but basically eking out a gain of 1.7%. Year over year, so taking a look from last year to this year, the numbers are supersized. Your S&P is up 34%, the Dow Jones up 26%, NASDAQ 36%, Russell 2000 42%, foreign stocks or international 21%, and emerging markets 11.3%. Really, really amazing. I think we talked last week that if you walk away with a return anywhere between 5 and 8%, you should be pretty happy if you're in an equity market or equity type of investments. And at this point, we're 4 to 5, in some cases, 6% more than what that is. So it's time to really take a look at your portfolio before the end of the year. Maybe get rid of some losses, take some tax losses on your tax return, but definitely take a look at things. But even more importantly, it's just interesting how, people always want to know the hot product of the day. And if you know me and if you work with me or know me, have talked to me, it's never a hot product of the day. I just don't work that way. It's more of looking at programs. But we do take a look at different trends. So I'm going to go back to November of last year. Now, the top 3 sectors last year were information technology, consumer discretionary, and communication services. So information technology made sense. I mean, obviously, with everybody being home or working from home, technology was king. Consumer discretionary, people had money and were buying everything they could. Discretionary means buying things they don't really need, hot tubs, pools, whatever it may be. And then communication services, obviously utilizing our phones, et cetera, et cetera. Now, to look at the difference of this year, this November, our top performing sector is energy, which is your oil and gas, financials number 2, and real estate number 3. So to kind of really bring that home, if we take it back to a year at the bottom 3 sectors last year, they were ready, energy as the worst, financials as the second worst, and real estate as the third worst. So we literally went last year from the bottom 3, and those bottom 3 right in order to be in the top 3. So this is why it's so important to reallocate, rebalance your accounts. The set it and forget it never works in a financial situation. You always want to be on top. And if you can't do it yourself, work with someone like myself, the Financial Chick, to help you to be in the right place at the right time. So it's just interesting. And then to look at the bottom three this year, we've got utilities, consumer staples, and interestingly enough, the third worst performing sector is healthcare. Again, not making a whole lot of sense at all, but it's really important to diversify and be in all of these different categories, because if you touch all the categories, you're going to have a portfolio that's not going to have wide swings. But we're running into the break. So this is the Financial Chick, Denise Nostrom, the company's Diversified Financial Solutions. I help you look for financial solutions when you feel like there are none. So feel free to contact me at 631-758-8691 or at financialchickshow.com, and we will reach out to you with with answers to your questions. But we're closing into the commercial break, so stay tuned and come back for more financial knowledge. Welcome back. This is Denise Nostrom, the Financial Chick. My company is in Medford, and you can reach me at 631-758-8691 or visit my website at financialchickshow.com. I'm here to help you on your financial journey. Over the years, things change, and I'm here to help you navigate all those changes. So yeah, it's been a little bit just this week. I don't know. I did notice that last night was a full moon. I don't know if any of you noticed that, but I definitely feel it. Like, it's just been a little bit crazy the way everything is going on and everything's moving and shaking. And yes, a lunar eclipse. It was a lunar eclipse, actually. So, just insanity that's going on. So I forgot, I usually do a Facebook Live for the whole show. I didn't get to the first half, but at least you'll get to have this half. But anyway, so moving on. So we were talking about the market. And where I left off was that how the market can change in a heartbeat. So last year, at this time, in November of last year, the worst performing of the bottom three sectors were energy as the worst sector, financials, which was the second worst sector, and real estate as the third worst sector. Now, if we go into last Friday, we had just a total change where now energy is the best performing sector. So let me give you a number. It was down 50% at this time last year, which was a year to date. This year, it's up 58.1%. So when you think, and a lot of times clients will come to me and say, listen, this fund's not performing well. Should we sell it? Now, the answer sometimes may be a resounding yes, because maybe a manager left, or the sector or the things that are involved in that particular fund or stock may not be very favorable. But a lot of times it's just, let's leave it and just wait, because you don't want to sell the losers all the time. Sometimes you do, but not all the time. Sometimes they're just waiting to do their thing. And that's exactly what happened here. To have a negative 50 to swing to a negative 58 within a 1 year, if you would have sold out at the bottom last year, you would have been sad. So it's just, you have to kind of look at these things. And like I said, if you're not watching it, have somebody that is, like myself or a financial advisor. So one of the other things that we take a look at and that I've been explaining to people is, and I'm getting calls all the time. I just got one actually yesterday. Clients are saying, people are saying that they have money in their savings account. They have a lot of money in savings or in money markets or whatever the case may be. And what are they getting? Not a lot of rate of return. The Fed funds target rate is at a 0.25. And what that means is that's basically the baseline for what rates are for credit cards, for money markets, for savings accounts, et cetera, et cetera. So it's historic low rates, and people are looking to make more on their money. It's a really important thing. So, and the Fed funds target rate, pretty much when the pandemic happened, it's been at 0.25. We had some higher rates prior to that from 2015 to 2016. Right through the pandemic. But prior to that, we were at 0.25 also. So things change. And sometimes things circle around and come back again, which is also interesting. So one of the things that was also a very good case in point, last year at this time, inflation was running at 1.7%. So when I was doing financial analysis for people and we were incorporating inflation and taxes into their situation, we were using around a 3%. So we were going a little high. Inflation this year at the end of October is running at 4.6%. So it more than doubled in just a year. Again, yet another thing that when we do planning or you're doing planning for yourself, you have to make sure that you're getting a good rate of return and we're beating inflation. It's great to say, I'm afraid of the market. I don't understand. I'm just going to sit. I'm going to stay in like a fixed account, or I'm just going to stay in a money market because I feel comfortable and that feels safe and it feels secure. But that's a way to run out of money safely in retirement. And that's something that you don't want to do. So watching this key inflation or these key market indicators like inflation. Unemployment a year ago was at 7.9. So we've definitely had improvement there where we're down to 4.6. So that's a good thing. GDP was way out of whack last year. We were at a 33.1% because we were coming back from a point where everything was closed and things were starting to open up. So it really, really spiked. We're sitting at 2% right now. Again, the swings are nuts. This pandemic has made like just very interesting on a lot of ways. But GDP at around 4% is kind of a good place. I know prior to during the Barack Obama administration, they were indicating that we would never get back to 4%. And then when the Trump administration came in, we got to 4%. So that was right before the pandemic. So we were there, we bounced up and bounced down, but we're sitting around 2% right now. So I tell you these things because they kind of, go into the planning that I do for my clients. We want to take into account all of these different things because if inflation is high, obviously the money that you're coming in or the money that you're taking if you're in retirement, you may need more because you're not going to be able to cover your expenses. So everything matters. And this is stuff that you're not going to probably sit and watch and take care of or have the numbers in your head. This is something that comes into my office every single week. So we know we're on the pulse of the market and we know everything that's going on to help you. Again, it's not just about the investments. It's really about everything, the full-fledged planning. So in that vein, it's year end and there's planning. And I'd say most of my time right now is being spent on making sure that everybody has or will be taking the required minimum distribution. Required minimum distributions need to be out if you are over the age of, it was 70 and a half, but now it's 72. As of the Secure Act that changed last year. So I'm just going to say pretty much if within the past year you turned 72, you need to take it out. If you're over the age of 70 and a half and have been for a while or have been taking your RMDs, you need to do it. Last year, there was a little bit of a hiccup because of the pandemic. People didn't have to take their RMDs, but it is back this year. So make sure we only have a few more weeks left. If you have an IRA or if you're not sure that if you need to take it out or how much you need to take out, you can definitely give our office a call and we can help you with that. But I'm sorry, I wasn't scared. The CARES Act. The CARES Act waived the minimum distribution last year, as I had mentioned, but they're back this year. And, it is a complicated situation. So we even had like a little hiccup in the office because they're changing the RMD tables next year. They had indicated that they were going to change them this year for 2021, meaning that whatever you need to take, it's going to be a little bit less, the calculations. They're making a change. They haven't changed the required minimum distribution tables in quite some time. But the government couldn't get their act together. So we thought it was supposed to be this year, but it's actually going to be 2022. So you may want to start planning and making sure that whoever you're working with knows that they're changing, that the tables are changing next year, and really look at how that's going to change your financial planning. And if the RMD that is less may not be enough to accommodate for your expenses. So that's something that you want to do. And as far as RMDs, the other thing that the CARES Act changed was the beneficiary inherited IRAs. So if you had one for a while, that hasn't changed. But if you just inherited an IRA within the past 2 years, you need to take that money out within a 10-year period. Now, again, up to your situation, whether you take it all in 1 year. Obviously, that's going to be a big tax hit, or you take it over a couple of years. But I think the bottom line with any of this is make sure you have a plan of attack. With my clients, we have that plan of attack, whether they're using it to take it out to put into their Roth, or maybe they're taking it out, to purchase a home, a second home, a first home. So have a method to your madness. Don't do things willy-nilly. I mean, that's something that we help our clients do, is to identify their goals and then help them with the various products that they have to do the best that they can for their situation. So if in doubt, definitely give a call to the office. And I know I've said this numerous times on the program, but Roth IRAs. Take advantage of the conversion opportunities now. Tax rates are historically low, and many believe, as we all do, that rates have nowhere to go but up. Possibly as early as next year. You know, the administration's meeting and they're looking at the bill, and it's passed one house, and there's a lot more to go. So we still don't have any definitive ideas of what's going to happen. But if we're betting people, we kind of know that there's probably a good chance that rates are going to go up. So do your Roth conversions. Again, call us if you need us, and we can help you through that. So we're heading to the end of the show. Thank you, Mike the engineer, for all your help. And I want to thank all of you for tuning in. But more importantly, I want to thank you, or wish you all, you and your families, a happy Thanksgiving, because next week, Thursday, is Thanksgiving. I can't even believe we're saying that. I don't know where the time has gone. But please enjoy. I'm thankful for all of you. I'm thankful for my family. I'm thankful for a lot of things. So it's time to really take a step back and really be thankful. We're pretty blessed in our life. So let's do that as a group. So thank you all for tuning in today, and I look forward to being with you again next Friday.
Advisory services offered through Blackridge Asset Management, LLC, a registered investment advisor. Securities are offered through Peak Brokerage Services, LLC, member FINRA, SIPC. Blackridge Asset Management and Diversified Financial Solutions are separate and independent entities from Peak Brokerage Services.
The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.